Hi, I'm Michael Newrock, and welcome to Zone Profiteering. In this lesson, I will help you with your enhanced use of the Trend Profiteer trading system by utilizing Profiteer zones. Zone Profiteering gives traders the ability to enter trades at extremely powerful levels and the ability to lock in key profit points, capturing bigger targets. Trading as a zone profiteer can make a trader experience the trading version of a gravitational slingshot effect, giving them access to the real market moves at exactly the right time. By combining trend and swing trades with these zones of profit, you can take bigger, quicker to move, and safer trades whenever you trade. If you are wanting to capture the market just like a market maker, then whatever trading strategy you're using, zone profiteering can take your results to the next level. My hope is that you take this information and apply it to your profiteer trades as trading with the use of critical, significant levels that can certainly make a positive contribution to the win rate for your trades and the amount of pips you earn. Now, the good news is that we've included as a bonus to Trend Profiteer an indicator called macro levels, where I've provided presets of these institutional macro levels for you on over 20 different currency pairs, but they can all, or the indicator can also be used to keep track of more recent key support and resistance zones, which are, of course, are our profiteer zones. So let's get into it. What's better when entering trades? That's my question for today. Entering trades when all the indicators are confirming a potential trade, or entering trades when one, all indicators are confirming a potential trade, and two, the price is at a key support or key resistance level that is in line with your intended trade direction. In other words, price is got the backing of support on a buy or the backing of resistance on a sell, in addition to the trade being a valid trend profiteer trade. Either a trend trade or a swing trade, does not matter. So let's have a quick look. Here's a chart example of a buy trend trade with an entry that was taken with the backing of a key support level. And because of the strength of these levels, the best trend trades are often formed around them. So what do I mean? Here we see last support. Here we see support being tested and holding. And here we see price virtually hitting that support level again, testing it again. Now, here we have a new trade off support. We've actually got a couple here. We've got a trend trade here. We've got a swing trade here. Another one here. So without getting into the actual trade entries, the point is that you want to buy when you're close and above to a support level. Okay, so in this case, support held and it saw the trade move up towards close to 300 pips. So what's better when setting targets? Okay, different to entries. Setting a blind target of a ratio amount based off the stop loss. For example, you want to say, okay, I'm going to be in the trade until I reach a 1-to-1 or a 2-to-1 reward to risk ratio. In other words, the profit is as much as the stop on a 1-to-1, or twice as much as the stop on a 2-to-1. Or setting targets based around key support or resistance levels. So similar to the entry points, but we're looking at targets now. So here you can see a chart example of a buy trend trade with targets based at around previous key resistance levels for this buy trade. By setting your targets just prior to the significant level, you improve the probability of locking in targets or taking hard targets for that matter with consistency. So here we have the trade entry. We're looking at a buy trade here. Okay, we've got resistance here, tested again a couple of times here, and almost here is again. And here we have another resistance level. Now, this one was actually based on a previous high earlier on, but this one here we've got it, for this level here. So we enter the trade here on perfectly valid profiteer trade, and let's say we placed a hard target of say 40 pips, 40 pips being hit over here, but we could have easily stayed in the trade for a little bit longer, up towards here around 60 pips, with the target being set just prior, just prior to this resistance level. That's where we want to place our target, or closer. So all I'm saying is that you're leaving potentially money on the table, pips on the table or in the market by setting your targets too short. Okay, so where do you place them? You want to place them where your nearest resistance levels are, on a buy trade, and vice versa, near and above where your support levels are on a sell trade. But we'll look at that shortly. So target one hit here just prior to the resistance level, and then another target placed here for target two, reaching 110 pips, again just prior to this resistance level. Now it did in this case make the resistance level, and that doesn't happen all the time, hence the reason why you place your targets prior to the key level, in this case the resistance level. So in this case it did reach it, it broke through, corrected a little bit, broke through again, and then finally collapsed. But there's no guarantee that would have happened, hence once again why we place our targets prior to these significant levels, because it increases the probability that they are actually going to be hit. And it's an awful thing to be in a great trade, but to hit your profit locking target, or your hard target for that matter, by to miss it by just a few pips. That's not what you want to do. So you want to place your targets intelligently so they are hit a high proportion of the time. And the way that you do that is by positioning them around or prior to significant levels being reached. Okay, so if you do not take these levels into consideration, you would either be taking your profits too early or locking in profits too late. And locking in profits too late, there's no guarantee it's ever going to be hit. So, it's maybe a situation where that winning trade ends up being a losing trade, and that's not a good thing. You want to minimize that as much as possible. So both outcomes are not optimal if you want to maximize your capital growth. So it's what I call invisible force fields. Don't trade against invisible force fields. You can't see them. You need to place lines on your chart to be able to see them better. You don't have to do that, but as long as you're aware of them and position your moves for your profit locking targets prior to those levels, you're in a much better position to do well with your trades on an overall basis. So invisible force fields are the critical support levels, resistance levels, and consolidation levels in the market. Think of them as the lines in the sand that traders use to determine whether a price is supported or is under pressure. So they are extremely powerful, and traders trade against them at their peril. In fact, these levels become psychological levels and can become self-fulfilling prophecies of where the price is most likely to start moving in a new direction, as well as where the price is likely to stop. Okay, that's because a lot of traders trade these levels. They'll trade recent highs, lows, consolidation levels, macro levels, Fibonacci levels, and they all tend to, in some places, gravitate towards similar zones. So if you're trading with that in mind, then you've got a better chance of hitting your targets and locking in profits. For example, when price tests a key resistance level and fails, then the price will typically fall. The level may be tested again, and if it fails again, the level denotes that price will struggle to go higher and that the sellers in the market, the bears, are in control. Therefore, trying to buy contrary to these levels is likened to a child bouncing on a bed and hitting their head on the ceiling. No matter how many times it's done, the likely probability is that the ceiling will not break, and all the child ends up with is a giant headache. Okay, so you just want to watch your trades. We're going to go over a couple of examples, but you don't want to be banging your head against the ceiling. You don't want to be getting into buy trades close to those resistance levels, those ceilings. So moral of the story, never buy into a trade below key resistance levels. Now, this doesn't actually show the trade, but it shows the price reached resistance, failed to break above, and this actually is a level that was set previously. So it hit it here, reversed, and then hit again. So you don't want to be taking a trade like a trend trade, or in this case, a swing trade, too close to a resistance level. Here we can't see one here, but if there was one, you do not want to be taking trades up towards these resistance levels. So the inverse is true for key support levels. Think of them as a concrete floor. No matter what you do and how much you jump up and down, you can't break through. The price may test this support level, but if you notice that the price reacts significantly, as in it's not going through, it's bouncing up and down, or it's bouncing off that support level. So if it reacts significantly or even dramatically at this level, then you know that this level is like an ambush waiting to happen with buyers, the bulls ready to stampede all over you. So, you know, the idea is you don't want to sell close to a support level. So like the resistance level, the more the support level is tested with price failing to break and hold below the level, the stronger the level of support. In the following case, the closer the sell entry is to a key support level, the more probable the trade will fail. So you can see here, support was set here. It held at this point, came close to testing it, and failed, bounced off it, and once again here. So you don't want to get into sell trades. Let's say if there was a sell trade here, or here, or here. You definitely don't want to be getting into trades that are close. You don't want to be getting into sell trades that are close to support levels. If you do, then it's wise to set your targets smaller than usual. Set your lot sizes smaller than usual because you're hoping for a break to the downside. If that doesn't happen, and likely not to happen because it has already demonstrated support, then you want to just enter that trade with eyes wide open, so you can minimize your risk and move your stops to at least to break even as quickly as possible, as well as having them small in the first place. So on the other hand, buying at support levels can benefit you greatly by getting into a trade that rallies significantly simply by trading with the key level. Likewise, selling at resistance levels can benefit you greatly by selling into a trade where price falls dramatically. So whatever way you are trading, the end result is the manifestation of high probability trades that are typically much bigger than when you don't trade at these significant levels. In other words, if you trade at these significant levels in line with that significant level when a valid trend profiteer trade comes up, you've got a good chance of not only the trade succeeding but generating potentially higher pips than you normally would achieve because it's got so much more to rally or so much more to fall because you're trading at those key levels. So, how do you identify these levels? Well, once again, the good news is macro levels indicators provided for you within the members area. They have presets of these institutional, or what I call macro levels, but it can also be used to include recent highs or lows, and you can just plug them straight into the indicator so they display on your chart. So yeah, it's pretty cool. So if you want to work it out manually, it's quite easy. Whatever time frame you were trading on, you can see highs and lows displayed as pivots. That's what we're really looking for. You can identify a pivot high by seeing bars rise to a high and then drop down with the close on either side of the high closing lower than the close price of the bar that made the high. And with lows, the inverse is true. You'll see bars falling to a low, after which uh, time the pricing rises, with the close on either side of the low bar closing higher than the close of the low bar. So what we'll do is go hunting for pivots in the weekly webinars as well, so we can spot these levels on whatever chart and whatever time frame that we're trading on. To determine critical institutional levels, the macro levels that the big players adhere to, simply do the same as above on the weekly and daily charts. Additionally, or even the monthly charts is what I use, the weekly and the monthly charts. Additionally, take notice of non-pivot major highs and lows, as well as identifying consolidation areas where price remained in a tight range for an extended period, and which can also be used as either a key support or resistance level. So once you've done this, you can now trade your time frame and be aware of where these invisible force fields exist. The result of being aware of key support and resistance levels is that you will now have a huge edge on traders that are unaware of these important levels, by being able to trade accordingly and take advantage of buying off support levels and selling off resistance levels opportunities. So let's look at a couple of examples. This is a 1 hour trade. It's a buy trade example for an entry. So we're on the euro on this particular one. We've got support here that was either provided from previous, or that is a new support based on this new low. And we can see it tested here again. So let's say we see a new trade opportunity here in either a trend trade or any one of these swing trades. Then it's a good opportunity to get into, because you've got support here and support already showing that it held. And in this case, the trade continued to rally with support at its back. So it really pays off to take buy trades that are reacting off support levels. In this case, price kept going up for well over 100 pips, although trades can be successful at any point when they are combined with these key levels. Okay, the support levels and the resistance levels I've been talking about. You can really experience an extra boost that is created by the power of the level, or what I like to call the profit zone. So anywhere, it's not an exact science, but you want to be able to, look for buy opportunities when there's a support level that's been proven to hold. That's what you want to do on a buy, of course. Here's an example of an entry of a buy position on the 4 hour time frame for the pound, with the setup forming above the recent support line. So you can see here again, last support was here. It was retested here. We've got a trend trade occurring here. Looks like we got another trend trade over here, and another swing over here. But whichever one you took, the point is, once again, you've got support behind you. You've got support at your back. So buying into a trade when you've got a proven support behind you is a good thing, as far as consistently generating a positive result. So once again, it really pays to take buy trades that are off support levels. In this case, price bounced off the support level, and after testing the level for the second time, a new buy trade setup was created, and price consequently rocketed for over 350 pips. So I hope you can see how powerful these levels are, and why it's a good idea to be able to take buy trades when you've got a support behind you, or sell trades when you've got a resistance level behind you. It just allows you to pick up some nice big trades. On the 4 hour charts, you can see big moves, but regardless of the time frame used, when a solid trading strategy is combined with a key support level, regardless of whether it's Trend Profiteer or another decent system, when you're combining it with support levels or resistance levels, big moves, for support levels to the upside are quite probable. And of course, they do apply for sell trades as well when used in conjunction with resistance levels. So here's an example of a sell trade position on the 1 hour on the Aussie. You can see the resistance level that has been previously set. So we've got last resistance here. We've got resistance being tested and holding here. We've got a new trend trade that occurs here to the downside, a new sell trend trade. You've got resistance behind you, and bang, just was a really nice trade. A couple of little corrections along the way, but nothing goes in a straight line. So you need to be aware of that. But what a beautiful trade, selling off a resistance level that has already proved itself. So just like the support level examples, it really pays to take sell trades that are reacting off resistance levels. In this case, we can see that price was pushing right up to the resistance level. So when a sell trade setup occurred, a trader could have taken it with very low risk. And you can see in that example, the pips that you would have used for the stop would have been very small in compared to the potential returns. So pushing right up to the resistance levels, when a sell trade setup occurred, a trader could have taken it with very little low risk, yet with a higher than average probability of price falling significantly and generating significant pips, which of course it did do in that particular example. Here's a sell example on the euro. You can see here last resistance. You can see resistance holding here. You can actually see it hitting again here. So it's a strong resistance level. So when it came up again and just fell short, but you can see it certainly tested it. When a trend trade occurred here, then we get a massive move down, and so by this stage it had hit resistance, tested it again and again here, and then again here, so an excellent sell trade, regardless of whether it's a trend trade or a swing trade. A sell trade with resistance behind you, and that's exactly what happened. In this case, the price reacted off that resistance. So because price was struggling against the resistance level, when a sell trade setup occurred, it was more likely to see price falling with ease. Because of this, the move was likely to generate significant pips. In this example, we saw a fall of over 400 pips. Once again, really pays to take sell trades that are off resistance levels. So the mirror reverse of the buy trades off support levels. In this case, sell trades off resistance levels. Here's an example of so let's have a look at some targets. That was all entry point examples. Now we're going to look at targets. How do we determine where our targets are going to be placed? Rather than just this cookie cutter, it's always at 25 pips for your first target, 50 pips for your second target, 75 pips for your third profit locking target. That's just not the way it's meant to be. You're supposed to be able to customize your trade and the parameters you're using for the trade management based on the specific environment. So let's have a look at how we use support and resistance levels when we're determining targets. We looked at it briefly, but let's just go into a little bit more depth. We've got a 1 hour chart here on the euro, and we can see this is the buy entry that we're looking at. So previous to this, we had last major high, resistance confirmed here by testing it not once but twice. We've got a resistance high here again on this pivot. Again, we've got the low on either side of this is lower than the close of either bar on either side of the pivot high is lower than the close of the pivot high. But it's really about just getting these zones. It's not, don't worry about getting it exactly spot on technically, because that's just not the way trading works. But you can see here there was this major correction, and so therefore that's caused this recent high. So we've got a buy entry here, and we've got our first resistance point here. So what do? We place our target prior to the resistance level to make sure that it's going to get hit. And the same applies here. We've got our resistance level here, and we've got our target placed prior to resistance being to the resistance level. Now in this case it did eventually hit it, and surpass it. But it's good to be able to take your targets and your profits with a higher degree of probability. In this case, you can see there was a correction here, and there was also a correction over here. So you'll see that happen all the time, corrections occurring around these important levels, and that's why you want to place your targets prior to those levels being reached. So notice that when the price hits targets based on previous levels of resistance, it's quite common for price to retrace or even just consolidate to test support and build up more buyer interest before rallying again. And that's exactly what happened. When positioning your targets on a buy trade, it's important to place these targets prior to resistance levels based on previous highs. If you place your targets like this, you are more likely to hit the targets, to lock in profits or take profits, and maximize the amount of pips you can extract from the move. Okay, so here's an example of a buy trade on a 4-hour time frame. So same concept, doesn't really matter what time frame that it's on. This is on the Aussie. We've got two major targets in place here. Last major high here, similar to before, we've got a recent high here. And we're looking at, we had the number of buy entries here with the trend trade and a couple of swing trades. So we've got this resistance line here. You could paint this on your chart manually, or you could just plug it into your macro levels as a recent high on this time frame. So anyway, where do you place your target? Just prior to the resistance level, which was easily achieved in this case. But you want to be cautious when you're trading. And once again, placing the target prior to the resistance level here. In this case, it would have been even an easier ride if you'd placed your target even a little more prior to the resistance level and not experienced the anguish of this correction. It eventually did hit, but there's no guarantees in trading, so you want to do everything you can to make sure that you come out a winner. And as far as targets go, it's important to place your targets prior to these levels. With sell trades, you place your targets prior to support levels. With buy trades like this one, you want to place your targets prior to resistance levels. So in that example, you can see that each of the targets are positioned just short of the resistance levels based on last major highs and recent highs. Just like with the previous example, by positioning your targets well, you can set your hard targets with an accurate success rate or set achievable profit locking targets so you can trail the trade for as long as possible, as well as generating maximum pips from the one position. So when setting targets, it's important to not let your ego get in the way of making profits. Sometimes resistance levels can be reached and surpassed, but it's generally a good idea to at least lock in profits prior to the resistance levels. Okay, so let's look at a couple of examples of targets. First of all, we've got a 1-hour time frame on the dollar yen, and you can see here we've got a major low here, and this is the sell entry that I'm looking at. You can see here a recent low from this pivot low as well. So what you want to do in this case is the inverse. You want to place your targets prior to the support levels, which in this case means above the support levels. So here's your support, place your target just prior to it, and of course it was hit nicely. And so too with this one, you want to place your targets just prior to the support level. And you can see up to this point anyway, it did eventually get hit, but again, there's no guarantee, so it may not have been hit, and it's a horrible feeling to have your trade so much in profit only to struggle to get the last mile, the last few pips, and yeah, it's not pretty. So on sell trades, place your targets just prior to your support levels, and you improve your chances of success. Just like the buy trades, it's normal to notice a retracement of price as the pair comes close to support levels based on previous lows. At times, it will break right through these levels, but it's typically appropriate to place your targets prior to these levels, just in case price does experience a pullback or consolidation prior to these levels, and therefore increase the probability of consistent success. And that's what it's all about. So therefore, when placing sell trades, place your targets prior to the support levels. So at the very least, you can lock in some profits. So here's a 4-hour example on the dollar CAD for how to determine your target. And this is the sell entry that we're looking at here. Now, you can draw your support lines. You've got your last major low, which is also a pivot low here. You've got another low that was selected at this point here. It could have been either here or here, but considering this target is here, you want to play it safe, is always my policy, and pick this one out of the two because it was so close. And then here you get another support level. So you draw those three in. You've got your sell entry. Take the trade. Place the target just above the support level, just prior to the support level. Was hit nicely here. Came down again, hit. The support was hit in both these cases, but there's no guarantee of that. And then here you can see here it's just a couple of pips shy. Imagine telling that story to your spouse. At the end of the day, you're not a winner if the target wasn't hit. In this case, if you were aiming for that major low, you're risking quite a bit. So considering the length of the move, you could have even placed your target even a little bit more above, just to you want to be hungry for profits, but you don't want to be greedy. You want to be able to take profits when you can. And in this case, as I've been showing, it's always typically just prior to those significant levels that you need to be so aware of. So in this example, notice that all targets were positioned just above the support levels and were easily hit. In every case, notice how prices corrected or consolidated prior to each level of support being reached. And again, that's just a normal way of the markets. Profit taking, a lot of people do profit taking, and that can cause those corrections, as well as buyers or sellers from the other side getting involved in the trade. And that's why you'll often see little gyrations in the market around those important levels. So whatever the symbol, whatever the time frame, by placing targets just prior to these levels of support, you typically have a better chance of your targets being hit with your equity converted into capital much more readily, or at the very least, you'll have the improved ability to lock in profits. Of course, this is for sell trades, placing your targets just prior to those levels of support. So many trades of the trend profiteer trading system will go well regardless of whether zone profiteering is utilized or not. However, zone profiteering helps you generate an even higher probability of winning trades, as well as some strong positive outcomes and taking optimal profits, all without risking more than what you normally trade. And that's the beauty of this whole way of trading. Therefore, before entering a trade, take time to consider whether the setup is at a level that is positive to your intended outcome. I'm confident that you will quickly realize that entering trades at these levels and setting your targets prior to these levels will produce consistently positive results. Naturally, how you grow your equity and capital dictates outcomes of your account. However, you will likely improve your results by taking profits or locking in profits at targets which are placed prior to support or resistance levels. In closing, I suggest you trade with zone profiteering whenever you can, and I look forward to seeing you achieve improved results. Of course, don't hesitate to participate in the forum, in the chat room, in the weekly webinars, and let's get you into that zone profiteering state. So you're looking at these zones as opportunities, both for your entries as well as your targets. So until next time, good trading, live well, and I'll see you soon.